Hey everyone, and welcome back to the first earnings review of this earnings season. We're starting it off, of course, with ASML. ASML at the time of making this video is down 4.4%. Gross margin was a beat, but net sales and bookings were misses. They did touch a little bit on the tariff situation as well, provided some guidance for next quarter and well for the full year outlook. So we'll discuss all of that in this video. I also want to touch on some specific news with regard to Google, so stick around for all of that. If you enjoy this type of videos, hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So ASML right now as a market cap, of course you can buy ASML in dollars, you can also buy them in euros on the Amsterdam exchange. At the time of making this video, it will have a market cap of just over $260 billion. As always, the PE wise, this is never going to be really a cheap company because, well, monopolistic companies rarely trade at cheap valuation or cheap pricing metrics such as PE trailing or even forward one. The forward PE sits at 24.8 times. Now, you can see that in the last couple of years, the last 5 years, it has had quite a lot of drawdowns of, well, 20%, 25%, even 50%. Right now, we're in that 40.6% drawdown. Year to date, we're down 16, maybe now closer to 20% or so, because, well, there has been some weakness with the semiconductor equipment makers, right? So not just ASML, Lam Research, Applied Material, KLA, we've all seen the weakness in those stocks, but the businesses have actually started to do better and better. So if we look at ASML's report, Q1 figures here, total net sales 7.7 billion euros, net system sales 5.7 billion euros, and install base management sales of 2 billion euros. Of course, this part right here, as they grow their install base, this number, of course, will grow with it, and that becomes, well, very, very lucrative business for them. We've seen that with the likes of Intuitive Machines as well, with that Da Vinci system. The more systems they sell, the bigger the install base, well, the better, and the more fees they will generate from that each and every year. Gross margin came in better than expected at 54%, operating margin at 35.4%, and then you have your net bookings, $3.9 billion. That's the miss that Wall Street is focused on, of which EUV bookings was 1.2 billion euros. So they were asked about tariffs and the potential impact on ASML in 2025. So it said the following. First of all, it's a very dynamic field that we're operating in when it comes to tariffs. Maybe it would be good to have a bit of a breakdown where it could potentially affect the ecosystem. First of all, obviously you have tariffs that could be imposed on shipments of entire systems, new systems into the United States, so that's one category. The second category could be tariffs imposed on parts and tools that you use for field operations in the United States. The third category could be on what we import into the United States for manufacturing in the US. As you know, we have some manufacturing capability in the United States, so anything related to that, that would be the third category. And the fourth one could be any other country imposing tariffs on things that are being shipped from the United States into these countries. So those are different, I would say, direct implications of tariffs. We're very actively working with the entire ecosystem to try and minimize the overall impact on the whole ecosystem as a result of that. Once we have a better understanding of how exactly it all works, but clearly our intent is that the impact that it should have on our financials should be as limited as possible. And this is what Christophe also talked about. To what extent will it have an impact on global GDP? To what extent will it have an impact on total market demand? I think it's way too early to discuss that, and therefore it's quite impossible to actually put a number on that. And I think that especially that last part, we're going to hear from a lot of executives. Moving on to some other comments about market dynamics and full year outlook. So they said the following. I think the dynamic is very similar to what we discussed last quarter. AI is still the driver of the market. The demand is strong, it remains strong, and we see two scenarios. If the demand on AI continues to be strong and our customers are capable to add capacity, so we have basically opportunity for an upside looking at the upper range of our guidance, the 35 billion euros. On the other hand, we still see some uncertainty with some of our customers that could also take us to the lower end of the guidance, the 30 billion euros, but overall the same dynamic. Now, by the way, going back to that service and field option revenue, which is basically the install base management sales, this is what has happened since 2019 on a last 12 months basis. This has grown at a compound annual growth rate of 18.1%. Moving on to gross margin for the full year. So first quarter 54%, second quarter between 50 and 53%. They do expect the second half of the year to be a little bit lower in terms of gross margin. There's a number of reasons for that. We do expect the second half to be stronger when it comes to revenue recognition than the first half, and as you know, High-NA is still margin dilutive. So therefore, we expect a negative impact on the gross margin in the second half as a result of that in comparison to the first half. We also expect a little bit less upgrade business in the second half in comparison to the first half. And also, as we just said, we have the uncertainty when it comes to the tariffs. If you take all of that together, again, with the caveat of the uncertainty around tariffs that we need to mention, we continue to expect the gross margin between 51 and 53% for the whole year. So still pretty good. Now, all in all, what I want to show you here is one, the end use, memory 42%, logic still the largest part here, 58%, that was 61% just a quarter ago. But look at the region mix right now. Remember, a year or so ago, we had 47, 49% China. Now second quarter in a row where China is 27%. Well, this time actually USA shrunk to 16%. That was 28% in Q4. South Korea went from 25% to now 40%. So yeah, you probably have the players like, well, SK Hynix, Samsung contributing to that huge increase here from 25 to 40%. So now South Korea is a big part of their exposure. Looking at some trends here in the business, of course, total net sales, they increase. Q4 is usually a strong quarter. If we look at gross margin, of course, for this quarter came in much better than expected, 54%. That's better than any other quarter we've had, well, in 2024. What's also very interesting to see is R&D cost, still remaining the same. SG&A cost also remaining the same approximately. If you look at operating income as a percent of total net sales, that has increased nicely to 35.4%. Same for net income as a percent of total net sales at 30.4%. And then of course, net bookings, that's one that is fluctuating. We've seen that in the past. And I mean, you can see that here. Q1 2024, 3.61 billion euros, then 5.5 billion euros, then 2.6, then 7 billion euros in Q4. And now we're back just under 4 billion euros. So that metric is definitely fluctuating. Yes, the market still pays a lot of attention to that, but you also have to pay a lot of attention to the other parts of the business, which are still doing well. Looking at free cash flow. So free cash flow for the quarter was negative. So a huge difference between Q4 and Q1, and well, even Q1 2024, that was also a negative quarter. But you can see right here, net cash provided by, or used in this case, financing activities, 3.1 billion euros. And of course, that will impact, in this case, net decrease in cash and cash equivalents. So all in all, this might not have been the best of the best quarter by ASML, or maybe the best of the best guidance that you wanted to hear. But I think all things considered, they're still performing very well. Again, focusing just on net bookings, I don't think is the right thing to do. If you look at the overall business, it's still very healthy, performing very well. They're seeing still demand. 25 and 26 are still going to be growth years according to them. Yes, there is some uncertainty with regards to tariff, but all in all, what you're getting here is a very solid business that is very well managed. Moving on to the last part here, and that's Google. So Google apparently faces £5 billion UK lawsuit for abusing dominance in online search. Alphabet's Google is being sued in Britain for potential damages worth about £5 billion, that's $6.64 billion, alleging the company abused its dominant market position in the online search industry. The case argues that Google has been shutting out competition through contracting phone makers to pre-install Google Search and the Chrome browser on Android devices, and paying Apple to make it the default search engine on iPhone. Well, first of all, Android devices, Android is owned by, well, of course, Alphabet Google, so that's a no-brainer. Second of all, with regards to that Apple and Samsung, well, agreement, yes, they are paying billions and billions of dollars, and I've said it time and time again, if they cannot pay them anymore, I think that's going to be a good thing for Google and a bad thing for Samsung and Apple, because that's basically, what is it, $15-20 billion that flow to the bottom line for those companies, and that's now going to stay at Google. Yes, there's going to be a minimal impact, in my opinion, in the usage of Google Search, but I still think the reward is worth it for Google. So if that happens, okay, we'll see. They continue by saying the claim also alleges that Google has ensured its search engine offers better functionality and more features for Google's own advertising offering than that of its competitors. Well, I mean, it's the same with Apple, right? If you say in the Apple ecosystem, everything's going to work much better and smoother. So, I mean, I assume it's the same with every other ecosystem that's been built out there, right? If you do everything inside the ecosystem, it's going to work better than if you start doing things outside the ecosystem and then try to go in and out, in and out, in and out. Again, we're punishing companies here because they are the best of the best. That's basically what's been going on for a long, long time. Yes, of course, they have become extremely big. And yes, of course, the small player might not be able to compete with them. Yes, I agree. But we are still in a market where the best product will win, no matter what. And we're clearly seeing this with the rise of the ChatGPTs, the Groks, Google's Gemini, Anthropics, and all of that. We're clearly seeing that, right? If there is a better alternative, people will start using that. So I always find it very, very strange that we are punishing companies because they are the best of the best, because they provide the best customer experience. That's why we have to punish them. Makes no sense to me. Oh, and last thing here with regards to Nvidia, Jim Cramer tweeting this out. As I said in my Painful Sunday think piece for club members, Nvidia has become a meme stock and it has to be cut back. Don't say thanks for telling me now, cause club members got the whole call. You heard it here first or second. Meme stock. Nvidia is now a meme stock. That's all I've got for you right now. If you enjoy this type of videos, hit all the buttons and I see you all in the next one. Bye bye.